Welcome to the Dividend Talk podcast, episode 223. Our portfolio allocation along the journey. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Good morning, European DJI. We're recording on a Sunday, a little bit later than usual, but how's your week been?
Very good. Like usual, spend a lot of time at work, but also spend some time working on our new website. Really happy with how it's coming. So this is about the Dividend Talk Premium, right? It's now a newsletter and PDF. We're shifting a lot to a brand new website to really increase the user experience. I hope it can go live really before the 1st of January. I had also someone helping me a little bit on Friday. So thank you, Joris. Shout out to you. He was a person that was willing to quickly test with me to run a little bit to the key elements of the website. He gave some good feedback as well. Let's see what we can introduce or include from that. But that's what's kept me busy, yeah. And for the rest, it's of course football. I saw your club winning from Real Madrid. Well done. I mean, it's amazing how this team is how this team is playing at the moment under the guidance of the new Dutch coach there. So kudos very much. It's hard to not become a Liverpool fan when they play like this.
Yes. See, that's I've been waiting 4 or 5 years for you to say that. Never mind this Man United business. But yeah, football is fun. Arne Slot came in. Quite a tough job to take over from Jurgen Klopp, I must say, but he's done it in his own way. I love how direct he is with stuff. He's got that Dutch directness, but not in a bad way. He just says it how it is. And let's see, it's a long season. We don't win anything in the 1st of December, so let's not get carried away. But we're here to talk about our portfolio allocation, and this is quite interesting because it was maybe one of our first podcasts way back. And it'd be good to actually listen to see how our mindset has changed on that, because I haven't listened back to it, so I can't remember much of what I said, but I have my thoughts wrote down here, so it'd be good. I might do that myself, listen to both and just see over the 5 years
how that changed,
how much that has shifted. But before that, news of the week this week has been quite, I would say, not on my radar. In Republic of Ireland, we've got the general election, which we voted for on Friday. So a lot of the week leading up to that and over the last few days has been focused around the general election. So nothing from my end anyway on dividend or company business, just boring politics.
Exactly. So for me also, there was nothing really that caught my attention. I mean, there's a lot of attention going to Bitcoin and such, but that's really not my circle of competence. My son was asking about this, like, Father, you knew when you were a student or when you just started working that Bitcoin was there and you had a friend that was buying some for a few dollars. Why didn't you buy them at the time? I said, son, that was really for hackers and this stuff at the same time. It was just people playing around with it, and I had no money. Yeah, so even a few dollars for me felt like wasting money, and I guess I still have that mindset today. So it's fair to say to me like have fun staying poor. But I was even reflecting on that, like, how could you know that at the time Bitcoin would be 100,000 now? If I would know that, it really was like in the scene of a bunch of hackers, right?
Yeah. I mean, it's not so long ago, even recently, it was dead.
Yeah.
It dropped below, was it 40 or 30,000? I can't remember the
Yeah.
number, and had this, not the golden cross, whatever the opposite
Yeah.
of that is. So it was doomed and all this. But look, it's a volatile asset. We know this. It's had
Yeah.
peaks and troughs, but people that hold on to it have
Yeah.
done very, very well, I must say. And those of us have not that do not hold it, well, good luck to us staying poor. But look, it is what it is. Crypto is out there.
Yeah, I'm
It's not.
trying really to teach my son a little bit about consistency and such, and that it's okay to miss out on some things, specifically if it doesn't fit in your tolerance for risk. But he says like, who cares? I will be a YouTube millionaire anyway. So
Nice. So what about dividend hikes? One of note, HP Inc. And that's quite an interesting company, because I know you like them a lot. They've hiked the dividend 5%, but the share price took a bit of a hit last week.
Yeah. I mean, they have been effectively putting out the guidance, which related to the markets was lower than they expected. So they punished the company. The company, by the way, started recovering already. But look, for me, this has always been a really nice company in terms of a value play, but also a share cannibal. So it has been buying back lots of shares over the years, which has also supported the dividend growth over the years. Yeah, I just really like it. I like that people really feel often like, why would you invest in a laptop business? Yeah. And the company, if you just look at the fundamentals, is hitting numbers after numbers after numbers. And of course, you have up cycles, you have down cycles. You know, we had the whole COVID boom, of course, where suddenly everyone needed computers for staying at home because they had money left. Well, we may be entering a renewal cycle again. I don't know. Consumers are still a little bit keeping the hand on the wallet. But in any case, this company is just a cash machine. And that's what I love about HP. And I'm very happy with the 5% dividend hike. Yeah, it's becoming a meaningful position for me, I must say. So, yeah. And I'm nicely in the profit as well, because I think my average price is $28 or $29.
Yeah.
So,
yeah. And they dropped as low as 21 or 22, if I remember.
Yeah, and I've been buying like on all those different ranges, right?
Yeah.
Been nicely dollar cost averaging. So I'm very happy shareholder here with average yield and cost of 3.7 and something percent. And yeah, let it continue to grow, I would say.
Yeah, nice one. And then the other dividend hike that I've took note of is Hormel Foods, ticker symbol HRL. Only a 3% hike, but it is their 59th consecutive annual dividend increase.
Yeah, amazing.
Show that to your son about consistency. That's what consistency looks like.
Amazing.
Yeah, nice one. So portfolio allocation along our journey. And I said in the beginning, this is actually quite interesting to listen back to see how we changed. But if I was to summarize my beginning and what my thoughts are in the beginning, we read all these books about being diversified, and I believe in the beginning I took this quite literal, in that I had to be fully diversified in every sector in corporate equities here, so just in equities. So I had the 11 sectors done out, and I had a little list of the percentages that I wanted each in. I can't remember off the top of my head, but I know consumer staples and healthcare were definitely top two. And then the rest of them were filtered down based on that. So I tried to adhere to that pretty much all of the time. I wanted to be within those ranges every month, every week, every time I was making an investment, which, looking back, kind of hindered some of my investment decisions, because I was buying in sectors not because it was the best company in that moment to buy, but probably to balance out my portfolio at this moment. And I can't remember when the aha moment was, or on reflection, but I remember having that moment thinking, I don't really need to be diversified right now. My portfolio was quite small. I'm investing the bones of 1,000 to 1,500 a month at that time. It is a relatively small portfolio. I don't need to be overly balanced here. I mean, if a crash happens, and I'm going to lose, or on paper lose a certain amount of money, but that's actually not a big deal, because my goal here is not paper losses or paper gains. My goal here is to make money from income, from dividends, and that's what I wanted. So I stopped kind of worrying about trying to be diversified all of the time. My selection basis back then was a little bit more based on metrics. It's still metric based now, but I do actually look into the company and the history and what I think their future growth was going to be. But I think back then it was really what their dividend yield was going to be, their dividend history, some things around payout ratios, and some other small metrics. And if they met that, and I felt they were undervalued, they were a buy, and I didn't care about anything else. Not probably the best. I made some mistakes, got lucky with a couple of ones, but yeah, it was quite interesting looking back how, not naive, but how strict I was to adhere to this portfolio allocation. And I've kind of gone 180 on that a little bit.
Yeah, and I said, I think we all go a little bit through similar journeys in general, right? Because if you don't have the knowledge, you try to acquire knowledge. And when you acquire knowledge, you quickly end up in the academic conversation about portfolio management theory and such, right? But when you're in the accumulation phase, really in the beginning, I mean, you will never be really diversified. I mean, the first time you buy, you have a single stock risk.
Yeah, exactly. And I think you're not as confident in your decisions in the beginning as well. And that's the reason why you over diversify, because you're not confident that if you make a mistake, that mistake is not going to cost you as much. So I think there's an element to that there as well. You're trying to acquire that knowledge, and in doing so, you're just buying lots of little companies. And I can't remember. I remember it was 2021. I was looking at my portfolio and had a lot of companies with just 1 and 2 shares, and I probably had about 50 companies in my portfolio. I'm like, what? Like,
was this for you the feeling of that you got, like, this was a clear case of diversification?
I think so. And I found it. I was just buying new companies all the time and not really looking at the ones I've owned, and just like my portfolio was getting too big to manage. I think I'm down around 30 companies now, and even sometimes now that feels like a lot, but doubling that 60 companies was way too much. And I believe back in 2021, maybe closer to 22, I decided I was going to try and trim that down. I had 40 in my mind first, kind of this 4-tier system similar to what you might speak about, and then I've reduced that further then down to 30 companies. But I suppose going back 2 years, 2023, I wouldn't say I've changed, but what I did is I have a presentation. I think I may have showed this to you, but I do this with my wife at the end of every year. And what I did is, my first slide is I have my goal. What is my goal? And my ultimate goal is to generate a certain amount of money from my investments consistently every month after tax. And that made me think, okay, how am I going to reach that goal? And when I broke that down, I said, okay, it's an income focused portfolio. I had 2 elements. I had this higher yielding portion that I wanted in closed end funds at the time, and my dividend growth strategy. But what I didn't have is anything related to sector there. It was all based on companies, and I have criteria around the companies, obviously their balance sheet and so on, but it wasn't so much sector based. It's more focusing on good companies that pay consistent dividends, that I believe have a competitive advantage, and that will enable me to earn this much. And I believe my diversification will come in terms of the closed-end funds that will give me access to all these different types of sectors and assets that I would normally buy in. I think that's where I left my diversification. But for my single stocks that I'm buying, I don't really focus too much on the sector. I just try and focus on the company and good companies. And obviously my criteria around minimum yield, dividend growth rate, and dividend safety, which we have on our dashboard, that I've learned is actually more reliable than my own thoughts sometimes. So that's my primary focus. Try and look at the underlying business, not so much the sector, and not let the sector influence my decision. And as such, I don't think I have many in materials. I have smaller positions in industrial, but there's some sectors now that haven't been attractive to me in certain moments so that they're not in my portfolio.
And how do you feel now about your portfolio? Do you feel it's in a good shape?
I feel it's in a better shape than say 2 or 3 years ago. Definitely, it's a lot more manageable. I have 30 companies. I'm a lot more knowledgeable about all the companies in my portfolio. There's 1 or 2 small positions in terms of closed-end funds that are maybe 50-50. As again, I started to learn them, and you make some mistakes, and I have my criteria around them. But yeah, I'm definitely a lot more comfortable in my top, say, 10 positions, which would make up nearly 60-70% of my portfolio. So that's where I would focus on those top.
And is there anything from allocation, portfolio allocation point of view where you still feel like, I wish I understood this, or I wish I could do this? Is there anything where you feel like there's room for improvement, or where you still feel like I need to learn something about this stuff?
Of course, there's always room to learn, and probably what I don't have a lot of is cyclicals, and I've mentioned materials and stuff, and that seems to be really cyclical. I have a lot of financials make up the bulk of my portfolio, but then that's not just financial companies. That closed-end funds are all classed as that, so it's kind of skewed. Then I have consumer staples, but in terms of the cyclical companies, I struggle there because they do have a history of either cutting or maintaining their dividend, but it's not as steady. And there is times obviously to buy them, but that's where I struggle. So I could definitely improve. I could definitely improve my sector allocation. As I said, 40% is in financials, but that's skewed a little bit.
Yeah,
but I could definitely bring that down.
Interesting. Yeah, and I think what is also interesting is that you're making a split between income focused, so closed-end funds and dividend growth strategy. Yeah, and that is because you don't expect dividend growth from the closed-end funds.
Exactly. I don't expect as much, but I also expect a higher starting yield from them. So I'm getting more income now, and I reinvest that. Whereas my dividend growth strategy is more around the dividend growth part. So I want income both now, but I want it to compound in the future.
So and what is your split between that 50-50 between closed-end funds and?
No. It's around 70-30, I think.
Okay. 70-30. And then in retirement, let's say that you're early retired, what is your expected dividend growth or income growth?
In retirement, that's a funny one. In retirement, I'm not too sure how I will change this. So
because you have inflation.
Yeah.
How will you deal with that?
I don't know, but my main plan is to get to a certain amount of cash that I know will cover all my bills, and that'll be inflation based, right? And once I reach that, I will diversify into other, like I spoke about this, buying property and stuff that my wife can rely on. So it's not diversification within just equities, but I'll have other areas. I also want to open up my own business again, which I will do. So that's probably how I will handle that. But at the moment, I have a certain goal based on my lifestyle now, and I know I can live comfortably. And once I reach that, I don't know if I will change too much about my portfolio.
What I'm asking, because you have a minimum expectation of 5% dividend growth.
Yep.
Yeah, on the dividend part, and then there's nothing on the other one, which would, I don't know, if I would do like the math in my head, it's probably like with your portfolio allocation split, it will be probably 3.5% afterwards if the trend continues, and that should be generally above inflation in the Eurozone. Provided we don't have these crazy spikes that we saw in the aftermath of COVID.
Yeah, I think 2% was always the figure I used in terms of inflation historically. 2%, and you get periods where it's more or less, but 2% historically is where I'll do. But in that moment, I might decide to go more dividend growth than high yield because I will have reached my income, so I don't need to take that higher risk to get more income. I'll already have reached that, so I might reinvest all my.
But that assumes that you won't be living off the dividends, because if you will be living off the dividends, you won't have money to invest, right?
Correct. But at this moment, my headspace is I'm not going to retire straight away when I hit that figure. I'm not going to retire, but it will allow me, as I said, to open up that business and to go into other assets, and then maybe eventually.
So that's really more financial freedom.
Exactly.
Yeah.
FU
Okay.
money. FU money is what
Yeah,
we
yeah.
call it.
And what about the Dividend Talk newsletter as a business?
Well, that's part of my plans, big plans too. We look, we're quite excited about this new website, so there's a lot of potential there too.
Good, good, good. Very interesting, and it's so nice to see also how we are both trying to achieve the same, but still have a total different approach to some of these things. Yeah, but I'm
Yeah.
also curious to what the listeners feel, because we may think that we're different, but maybe our listeners says like, you just use different language, but it comes down to the same, right? So,
Yeah.
what's good to know, maybe if I start talking about my portfolio allocation strategy. So I do have a degree in management related topics. I don't want to go into details there and say what university and such. So I do know how how analysts and financial planners look at it using the efficient portfolio frontier. Yeah, you can go Google it, efficient portfolio frontier. And what you really can do there is, like, for instance, in the equity part of the portfolio, you really look at what you want to achieve as a portfolio with a high return given the risk level. Yeah, and you can plot it, and you get such a nice curve from left bottom to right top, and then you will see your holdings, and they need to be nicely around that line. Yeah, and that's really what it is about. And the idea behind it is that diversification across asset classes is there to reduce risk. But then you're talking about real estate and equity, like what we do, stocks. But then also that the standard deviation of returns measures really the investment risk, so the volatility. And a lower correlation, let's say, between the securities should also result in a lower portfolio standard deviation.
Yeah.
So you don't want to have you don't want to have Hershey, Mondelez, and this all, and then say I'm diversified. Yeah. So it is more like I have Hershey and I have Shell. Yeah. They may be totally not related to each other, and therefore your portfolio is more efficient. So I know this stuff. It's very academic for me, and I know that many analysts look at it like that. But then there's life, yeah, and there's pragmatism, and there are different investment needs. I'm not here for total return.
Yeah.
I'm here for a steady growing income based on reliable and safe dividends. So and that's why I'm not so interested in that portfolio. It would be maybe an interesting exercise one time to plot my portfolio a bit on it. But I can tell you, when I really started, I had no portfolio strategy. I was just buying what I found interesting, but I wanted to make sure that I don't buy again what I owned already, because I didn't want to have all my money in one bucket. And I've said it before more often. For me, investing the first time €1,000 was very scary. Yeah, because I was living on €100 savings budget that I could save €100 a month. Yeah, and then suddenly when I got to that moment that I could start investing because my salary grew while my cost stayed flat, at a certain moment I was able to put 1,000 in. 1,000 for me, whoa, that was a lot, really a lot. So definitely I didn't want to put like 2,000 into the same stocks. yeah. So or 3 or 4. So I was buying, and at the moment I was a lot influenced by people like Jason Fieber and such that were writing about dividend stocks. That's how you discovered them, the dividend aristocrat list. And that's really how I started, and how I also made my mistakes. So if people are interested now in Kinder Morgan, I mean, this CEO said, like, our dividend is safe. We have this toll model, right? Toll operating model. But yeah, if there's totally no gas or oil going through a pipe, then nothing will ever, there's nothing to charge, right? So he had to cut the dividend. So that's where I also learned an important lesson, that the incentive of a CEO when talking about the dividend is not necessarily aligned with the incentive of the investor either. Yeah. But then later, when my portfolio started to grow, I may have had 10,000-15,000 K in it, and I felt like, okay, it starts to become a lot of money, much more than on my savings account. I've never even seen so much money in my life. And then I really started to worry about portfolio diversification. But I knew that using the efficient portfolio frontier just doesn't suit my needs, too academical. So I thought, okay, this first principle thinking, why am I investing? Yeah. Okay. What am I worried about? Okay, that I will get a dividend cut. So I really started thinking like that, very pragmatic. So I even thought like, forget about all the financial stuff I learned at the uni. Let's not think about that. And then really I thought like, okay, I started writing down my rules. I just don't want to be impacted too much when I have a dividend cut. So hence, what is comfortable for me? Well, if I would retire, let's say with financial independence of 110% above my cost level, I can afford 1 or 2 dividend cuts. I even thought like, let's go for 100%. If 1 or 2 dividend cuts are there and I would lose maximum a certain percentage, then the other stocks with their dividend hikes should carry that weight so that I end up on 100%. Maybe I would have some inflation impact, but okay. That was the worst case scenario that I was thinking about. So this is also then telling me how many stocks I can own. Yeah, because I didn't feel comfortable that a cut would be more than 4% for my top 10. So my highest conviction ones that I want to have the most money in. And that's really how I started to think back and design my own portfolio allocation. It's not based on any academic theory that I learned, but more like what gives me comfort. And from that, I derived the 4-tier system because I felt like, well, not all my holdings I may have the same conviction in, or they may not have the same quality as how I assess the quality of the company. So that's why I also started working in tiers. And then tier 1 should, let's say, have up to 4% dividend income allocation. Tier 4, 1%, tier 3, 2, tier 2, 3%. That's kind of the thinking from a dividend income point of view. And that's how I started to plot my stocks in there. And then I started to actually also design the other stocks. Like, okay, what would actually be a tier 1 stock for me? Because now I've been just buying whatever someone wrote about, and I did some due diligence and thought like, yeah, it's indeed a good balance sheet and this and this. So but then I thought like, but I need to do really fundamentally say like, look at the world. So I literally opened up the 100 best brands in the world page, and I went through those 100 brands and I started looking which of these are dividend growth companies, and from there I started to kind of compile my list, doing some research. That's really how I started working over time when it comes to portfolio allocation. And with that, I also said like, well, then probably for me it's 40 stocks. On 10, I really need to pay attention. But actually, over time, I learned that on my top 10 holdings, like Microsoft and such, I actually need to pay the least amount of attention. And typically, my attention goes more to the ones in the lower tiers because there's much more volatility or much more uncertainty in my knowledge involved. But then I also started to think like, okay, but there is something in this efficient frontier around correlation. So I also set kind of rules to the sector. Yeah. So I really wouldn't like to have sectors that are more than 20% of my portfolio. It's not needed. I also looked at the list of stocks and I thought like, it's not needed. Why would I be 60, 70% in technology or 70 or 80% in consumer staples? Yeah, so that's also where I started to put some guardrails there. I'm not, by the way, I'm not strict to all of these. What I mean, like if it's 22% or 25%, I really don't care. It is kind of, for me, like kind of a watermark to move towards too. So based on that, I really came to my ideal company overview, plotted on the 4 tiers, and then I just started buying them when I found they were attractively valued or giving me the right yield. Now, then we have also a podcast and a newsletter, and I discover so many nice stocks. So in reality, I don't have 40 stocks today, but 54. For that, I tend to do every May spring cleaning. But this year, I've been so busy with so many things that I didn't write my annual report this year, and I didn't do spring cleaning. So I have a lot of things to catch up to, and I may actually just do a winter clean out in December, maybe some tax loss harvesting. I don't have many stocks in the negative, almost buyer maybe. Yeah, so I may do that a little bit to offset some option income that I have on the side here. But if you then look at my allocation at the moment, there are two parts of allocation that I want to share from a sector point of view. One is the just in terms of the value of the holdings, not talking about the dividends. Here, my the IT sector is 18%, consumer staples nearly 17%, healthcare 15%, and financials 14%. When I talk about financials, think about the insurance companies. Then I have REITs and energy around 11 to 12%. REITs 2 years ago was 2 or 3%. So the opportunity we had last summer into this year really allowed me to build up this position. And that's also good to know that throughout the years, every year there's another sector impacted with something. So now I do dollar cost average, but not. I'm now more opportunistic. Just with the sectors. If a sector is attractive, I will go above my allocation rules because I know in the upcoming few years this will automatically correct itself again because I will be buying in other spaces. Yeah. Now, but then if you look at my projected annual dividend income per sector, it looks actually quite different. Because here financials, because of the insurance, is 23% nearly. Yes, so it was 15%, 14, 15% in the value. So you can see that they are just more higher yielding positions for me. And information technology, while it's 18% in values, only 6% in contribution to my dividends. Yeah, and this is also a little bit to your point. I've got the insurance companies more for the higher income right now, while they are still presenting good dividend growth. And the IT stocks are Apple, Microsoft, and they of course have much more expectation of continuing dividend growth into the future. Although I must say Apple is already having a decent payout ratio. It's not like they have only 10-15% payout ratio. Yeah. Same for Microsoft. So I also need to have a deeper thought about that. All in all, if you then look at my top 10 companies from a dividend income point of view, Shell is above the 4% threshold. It is 7%. Legal and General is almost 5%. NN Group is 4.7. Realty Income is 4.7. AppFi is 4.3. And ASR is 4.1. And then Koninklijke Ahold Delhaize is nicely on 4%. My dividend income still needs to grow overall, but it's clear that at least Shell is in my level where I wouldn't feel comfortable retiring on that amount of dividend income from an energy stock. Yeah, it's just like the company I saw the biggest opportunity in COVID, hence why I was loading up a lot there. But it's at the same time, therefore, also a lot of dividend income that it has generated for me, and I have a lot of dependency on their income. So I think it will be around 5% if my income will grow in other areas, and then it may be okay, but it may mean that instead of 100%, I go for 110%. That's more where I'm thinking there.
Yeah.
So again, it's nothing really around theoretical here that I've been implying. Of course, I've applied some lessons learned about not putting everything in one sector, but mostly I use just very pragmatically, like why I'm investing and really think backwards from that position. And that has really helped me in shaping my allocation strategy.
Yeah. It's quite apparent when I listen to that. It does match your personality so much. It's more of a risk-based and rules-based kind of strategy that works extremely well. But when I look at your top 10 dividend players, I notice Microsoft is not in there, and I know this is a large position for you. And you were asked this before, but have you given more thought into that? I mean, you said earlier you're not here for total returns; you're here for income.
Yeah, let's go to this question, because we also got from Alex, our admin from Facebook, a question, and he was talking about. I said, do we also do something that is called capital recycling as part of the strategy? Yeah. So he says by default his intention is to hold forever, like my Microsoft position, not trade in and out, but then also looking at when it goes much above the intrinsic value, then So he says sometimes the appreciation of a stock price is far beyond the growth of the business to an extent that the valuation becomes the biggest risk to the position. So if you bought at 10-15 PE and then it shoots to 25-30, do you consider selling and reinvesting where there's more value? And this is exactly, I think, hitting on this question.
Yes.
I've been doing such things in the past. I sold my McDonald's position at $120 when I bought it for 19. I feel like, no, this is way overvalued. I bought it at a 4% yield. And that's where I learned the hard way with a few of these examples, that you should let your winners run and not cut the flowers and water the weeds. Yeah, and this is why I'm not selling Microsoft, really, for this reason. And I may be stupid. Maybe this will be a future learning. Same with Apple. For me, it's way more interesting, this thought about Apple, because it gives a 0.6% yield. And I don't have the same amount of conviction for Apple as I have for Microsoft. Microsoft is firing on all cylinders, and they're not so much dependent on a few parts of the business. Yeah, so I feel like if the iPhone is dead, the services of Apple will become less, the attractiveness of the whole brand will become less, and it will impact a lot. With Microsoft, they have so many brands as well, where people may not even know it's Microsoft. Yeah, whether it's the Xbox franchise or whatever it is. Yeah. So, but that's why I'm letting my winners run. It's something I stick to. Whether it's wise, time will tell. So far, we have been discussing, right? It was largely valued at 200, at 300. Now it's at 400. But the earnings have been typically catching up with the valuation. And that's something I don't see so often. Often I see the stock go very overvalued, and you just see in the fundamentals, it's like 5% growth, 10% growth, but the stock shot ahead of itself, right? And you see them often come down. With Microsoft, I have seen that the earnings started also growing exponentially due to the cloud business, and the cloud business becoming more, getting a bit of distribution or a bigger percentage of their EPS. So yeah,
it's quite interesting. Obviously, Microsoft has been a bit of a unicorn in that.
Exactly, and I don't have too many like those.
In that, but say, look at your Apple position, and you probably know if you sold that, and you could put that into a more of a dividend growth orientated with a better starting yield, because we've done the maths, right? It would put you in a better position to meet your income goals. And how are you not tempted to do that? I mean, personally, in that situation, I would be 100% tempted.
I am thinking about that sometimes, but I guess I can control my mind sometimes better than my click finger.
Yeah, nice. But I think what Alex has said around the appreciation of the stock price is far beyond the growth of the business.
Yeah,
I think that is key to that. And look, you give this example of Microsoft, but how many companies do you see do that? Probably.
We spoke about Bitcoin before. If I would have bought Bitcoin for under $10, I would have probably sold everything at $20.
Yeah, true. we'd be rich, but yeah, no, it's interesting. When I look at your portfolio, and I know some of these information stocks you have, I mean, in your position, I think my click finger would be more controlled than my mind in that position. But it's
okay. But I give you another statistic then.
Go for
Microsoft yield on cost 7%.
I know that's high. But what's your Apple? 2 or 3?
3.2%.
3.2
with a current yield of 0.4.
Yeah,
but it's just showing like the dividend continues to grow. Yeah, and I don't see the dividend at risk there. So I just feel like, okay, it's just paper money. But true, if I would be in a very desperate situation, I could sell it. Let's not forget, I also need to pay 90% capital gains tax. It's a lot of money as well. But I would, if I would be very desperate for income, Apple would be the first position then that I would consider selling to boost my income.
Nice. No, it's nice. I don't think much has changed in your strategy over the last couple of years. I remember yours.
I'm less strict to it because we have this newsletter and everything, and I see so many great companies. And I just want to own them then. So I'm just a stock hoarder, a dividend stock hoarder, and it's helping me actually my diversification, but it's not helping me in my ability to maintain the portfolio. Yeah, and if I had such a busy year like this year with all the holidays that I all did, then yeah, you get quickly a polluted portfolio, and that's where I want to look again a little bit. Maybe with Christmas that I sell a bunch that I feel like, well, they ended up in here, but do I really need them? Maybe not. Yeah, because I have a lot of such small positions as you mentioned as well.
Yeah, nice one. I'd love to hear people's thoughts on this on Facebook to see what their own portfolio strategies is and how it actually differs from ours and our thoughts, and quite interesting. But let's move on to some listeners' questions. And Fabian wrote an email to us, and Fabian has come to realize that his interest in dividend growth investing stems not just from the motives of an investor, but apparently as the mindset of a collector. And you just touched on it right there. You're a dividend stock hoarder, but what he's saying is that he gets satisfaction of tracking high quality stocks for years, waiting on those rare opportunities when their true value goes unrecognized by others, Microsoft.
HP Inc.
HP. Cultivating Connor. I can't pronounce that right.
Connoisseurship.
Yeah. Cultivating what you own of the market and honing your ability to assess a company's value. And there's a couple of other points, but all in all, I agree with Fabian. I do think it is the mindset of a collector, and buy and hold. I think you have to have that mindset.
I was collecting post stamps with a child. Maybe that says enough. But I do clean my house. It's not like when you come into my house that you see stacked up to the walls all kinds of stuff that I found or collected somewhere. No, that definitely not. My wife would also probably quite quickly leave me, or just clean it herself and throw it out.
Yeah. Luckily, you have a broker to hold all those stocks. Imagine keeping all those all those certificates.
Oh, yeah. Well, I've got a nice room for that, but yeah. But I can very much relate to this. And that's what I often say, that dividend growth investing just generally fits my character the best. Yeah. Growth investing not and such, but dividend growth investing does.
And part of his question was, do you think this negatively impacts your returns? And
yeah, probably. That's why I'm not in certain other areas of the stock market where maybe people over the last 5 years have done better. Yeah. If I would have thrown everything into Nvidia and such because they didn't pay, let's say, a dividend that interests us, I would have maybe shifted more towards high quality growth companies, and I would have probably just thrown some money at the wall and see what sticks, and I would have had still better returns potentially. Yeah. Look at this year. Yeah, how much the S&P 500 went up? Is it 25%?
20, yeah, 20.
Yeah, I bet my portfolio year to date maybe 15, 16%. I don't even track it, but sometimes my broker shows me such a statistic. But we know where this growth comes from, right? From the Max 7 there. So depending on your exposure to this, you will be in the 25 to 50% range. Yeah, here. So definitely, it does negatively impact my return from that point of view.
Yeah, I'm lagging the S&P 500 by 3% this year.
And what is the S&P 500 doing?
It's down 23 point something percent. So
yeah, then I'm lagging at 8% or 7% probably.
Yeah, so quite interesting though. Jan has asked us about our circle of competence. Do we take the time to dig deep into a new circle of competence to open up new investment possibilities?
Beyond dividend growth investing, not really. I've been exploring real estate a few times, but in my neighborhood, there's nothing that gives me a proper yield. So, and that's all the time a bummer, because I would love to own 1 or 2 apartments supported by some, let's say, a loan to value of 70%. And have it cash flow for me, and the rent and the tenants pay the mortgage for me. But there's just nothing in my neighborhood in Poland. It's quite expensive, the housing market. So you would need to be in it for capital appreciation. And then we come back again to my whole investment strategy, my character. I want cash flow, mostly. And for me, the market is just very overpriced from a cash flow yield point of view.
Yes, sometimes within dividend growth, I learn new concepts such as closed-end funds is one. But I try and stay within my circle of competence for as much time as I think that I've come as close to perfecting it as I can. I still think there's a lot to learn. So that's the stage I'm at. Flo has said he's investing for many years now, but has a big problem. He finds it really hard to invest new money into companies which he already owns, and particularly those that have lots of capital gains so far. I think this is something we can all relate to.
Yeah, this is price anchoring. He's being price anchored. And he says, for sure, just looking at the numbers should be the solution, but it's often not in my case. So he's heavily price anchored. And the fun fact is, would you buy it today if you didn't own it yet? Because the other stocks that he is buying, he isn't price anchored. Yeah. So, you know, that's the tricky thing about this, right? And I really feel like it's all about that, getting price anchor, being aware of being price anchored, and then being able to take the emotions and the price anchoring out. I think that's the key. And if he can't, then I don't know how else to do that.
Yeah, it's tough. It is tricky. And sometimes for me, it's company dependent as well. Sometimes I have it more on some companies than others.
True.
But
I started buying Hershey at $100, and then I started buying it at $170. I had no issue with price anchoring at all. But I got less issue with that over time because I focused more on the dividend safety and whether it's undervalued or not. Yeah, I find it harder to buy stocks that I own already a lot from, and they're kind of fairly valued. Then I really want discounts. And sometimes the discount means if it's a recent position, that it needs to be cheaper than what I bought. But other than that, I'm good.
Arcadius has asked about Morningstar. Do we take their fair price and moat into consideration when doing due diligence?
No, not really, because I just mostly look at the 3 financial statements and the analysis that we do about the company. In the past, I looked sometimes at that, but my issue with moat is really practical. I've seen too often that people are claiming companies having a big moat. For instance, DocuSign, a big moat, and then when you look back at it, and what I've sensed already at the time, where is the moat? And moat for me is something like sin stocks. Moat is very personal. Most people will agree that a tobacco stock is a sin stock. There will be a few people that will say, well, you know, it allows people to have fun. It allows them to de-stress and gives them therefore a better quality of life. Yeah. So you can always put a positive spin around it. With every business that exists in the stock market, specifically in the S&P 500, you may assume that there is some kind of moat. Otherwise, they wouldn't even exist and already be out of business. Yeah. So I find moat really difficult, but I think most people will agree that a certain stock has more moat than another. Yeah, because of, I don't know, how well the business is different, like ASML. Yeah. But it is only a moat until there comes another technology invention and another company can do it smarter, and then suddenly the moat doesn't exist anymore. Yeah. So that's why it's so hard for me to really take moat at face value, and it can't. I say you can't escape from doing your own research on this. The fair price. This is again what the expectations they have priced in. It's sometimes interesting to see how many stars they have, but then it's more like first I do my own valuation and then I would compare. But actually I never compare with Morningstar anymore. I'm talking now about behavior that I had 6, 7, 8 years ago.
Yeah. I don't look at Morningstar either. Manny Mystery, what are your 2 to 3 key resources for data and investing news and research? Generally, it's normally just the company's annual investor relations. Sometimes I look at Seeking Alpha just to read the comments. But usually if I type in a ticker into or I want to research, it's the same 2 or 3 websites that just give generic stuff that it's not really in depth enough. It gives you kind of fluff. So I've come
Yeah,
away
and I
from
look
that.
into our own dividend stock cards because I know I've done all the
Yeah,
research with you in it. Yeah, and we
exactly.
trust each other on the research, so that's why I look that. But what I also often do is product review. So there are
Okay.
companies that provide products directly to consumers,
Yeah.
and then I just want to get a feeling for what those products are. For instance, buying Snap-on or Black & Decker, you want to get a bit of a feeling for like how do the drills look like, what's kind of the branding behind it, like with Hornbach as well.
Yeah.
Yeah, so I do sometimes this stuff. And Thule, everyone owns Thule on a campsite. So then with family or when you meet some people on the campsite, you ask them, hey, why did you buy Thule? Yeah, so these kinds of things I do, and it's more like the Peter Lynch approach, but you can't do that really for Apfi. Yeah, I don't know anyone who's a Humira patient that
Yeah.
is going to tell me about the drug impact. Yeah.
Yeah. David, no, Richard first. Richard asked us to recap on our current brokers that we use and why we favor them. I've got two, the Gyro and Interactive Brokers. I use Interactive Brokers more. That's actually where the bulk of my portfolio is. It just seems to have everything. But look, both are low cost, but I just feel like Interactive Brokers is safer. That might not be true. It might not be a true statement, but it's just how I feel. Like I'm more comfortable with Interactive Brokers, but I do own two.
Yeah, I have the same for the same reasons, the same outcome. But I also have some trading 212 for the European Noble 30 Pi that I have, and UK Wind. I couldn't buy them at Interactive Brokers, but I could buy them at Trading 212, and I think it's because it's a UK broker.
Ah, that's really strange. I can buy them on that, so that's quite interesting.
Yeah, you're from Ireland. Maybe that's the reason.
Yeah, we're all European. Should be the same, no? David has asked us, is it possible to transfer stocks from one broker into another broker? I think that depends on the broker.
Yeah, no, but you can typically do that. But that means then you need to submit a request, so you can transfer shares, but often it comes at a cost. Yeah, so sometimes brokers that are new on the market, they offer this for free because they want your portfolio, knowing that commissions will follow. But otherwise, it may come at a cost to transfer out.
Yeah, and I think someone mentioned on Facebook, sometimes the other option is they make you sell a portfolio and you have to buy it at the new broker, and obviously that has tax things as well. So
Yeah. So I, for instance, transferred everything out of Saxo at the time when they had when they were really under scrutiny because they kind of screwed up with the acquisition of Bing, and then I was able to transfer everything out for free to Interactive Brokers.
Yeah, nice. El Kuba has asked about our thoughts on fractional shares. Is it a useful tool for individual investors?
I personally try to stay away from it, except for this Noble 30 Pi, because I just like to own whole shares. Probably I have this collector mindset, but also deep in my mind, I have something like, how can you own a fractional share? What do you really own then? Yeah, but I'm not against it. I think specifically for small investors, this is the outcome to own some shares that you otherwise could never own. So I do think it's kind of, how you say that, democratizing the stock market. So I do believe bottom line, it's a good thing, but I would always read the small print behind it. Do you really own them?
Yeah, it's better to own fractional shares than no shares at all. That would be my motto.
Exactly.
Hussein has asked us about, well, more so you, does your hate to banks not create a solid investing case for them? They are charging crime interest rates, can risk billions to risky projects because governments will save them and have tons of hidden charges.
Yes, that's true. If you can't beat them, own them. I like that thinking. So yeah, he's technically right here, but show me a bank, show me like a set of banks with decent dividend growth over the years through the cycles.
You're ignoring Canadian dividend banks.
Yes, and I'm ignoring some American institutions with dividend aristocrat status. So yeah, some will, and this is the cost, the price I pay, let's say.
The joy of missing out.
Or the pain of missing out.
Mike has asked, have you guys read the book Discipline of Market Leaders by Michael Tracy and Fred Burshama. No, I haven't read it, but apparently it's about operational excellence and gives readers a model to analyze the performance of companies and find what is their competitive advantage. No, I haven't read that at all.
Me neither.
Eric, tech companies are drawn scrutiny as monopolies. Google, Microsoft. What are your thoughts on this?
Well, not just recently. I think recently in America, but in European Union, this has been already for almost a decade, right?
Yeah.
I mean, let's really see this as a free market. But then there comes a question if there's market manipulation. I mean, I let the regulators deal with it. In such case, companies may need to spin off things. Oftentimes we find that the individual parts are more worth than the sum of all parts in the business. So I don't necessarily see it straight away impacting shareholders from a return point of view.
No. Question then from MMAC. Which dividend companies do you think best meet the following criteria? Simple, repeatable, scalable business. Coca-Cola springs to mind as soon as you say that.
Yeah, exactly.
That was the first company I thought about. Pepsi and Coca-Cola. Dividend.xe. What are your thoughts on Canadian National Railway, CNR?
I have literally no thoughts about them.
I remember looking into them way back in 2020, I believe. Look, I think as a long-term investment, I think it's definitely worth looking into. Railways are not going anywhere in America and Canada. Let's be honest, it's needed quite a bit. I think that the problem I always had with these was they always seem overvalued because it is a monopoly. Basically, I think there's two railway duopoly, should I say, in America, and it always just seems overvalued. And we talked about price anchor, and I could never invest in it. So I looked at it, liked it, thought it was overvalued. It hasn't got any cheaper since I've looked at it, so it's never come back onto my radar. But as a business, and we talk about moat, I think it's a good choice for a long-term investment. Centrino has asked about LYB at the current prices.
I haven't done proper analysis on these, so I couldn't really tell you.
Yeah, again, it's a company that I had a long time ago, but remember they went bankrupt, cut the dividend, and that's kind of stuck with me ever since. And honestly, I find it a hard business to get a hold of as well. So it's not on my radar either. Dividend Collector has asked us about some high-yielding midstream companies such as Enbridge, Hess Midstream, or Delete Logistics. Have you ever looked at any of these? No.
I have looked a few times into Enbridge, but I can't remember what I thought about it. I really need to go deep into my notes. I remember it was a high yield, but always something that 6% at the time, but something prevented me. I think it may have been the sustainability of the business model that I have worries about.
Okay. Yeah, I've seen this company pop up a bit, but honestly, I've never looked too deep into them. I know they are a high yielding option, but
yeah,
I've stayed away. Krav Akala has asked us about a company, AES, ticker symbol AES, which I think is AES Corporation. Have you ever looked at them?
No, it's quite interesting. We get like the fourth question about stocks that I'm really not so familiar with all. So no, I'm sorry.
If I'm right, I could be wrong, and I probably should look this up, but I think they are American utility company, utility and power. But no, I haven't looked at.
But maybe
American.
we should. I see that there's a market cap of 9 billion, PE ratio of 9 at the moment.
Yeah.
So it is trading around the 52 weeks low. Actually, it hasn't been trading here since mid 2019, where it is now. So it could actually be interesting. What is the dividend yield on this one?
Let me quickly check. 5%. I have 5%, 5.3%.
5.3%. Okay. Yeah, I don't know the dividend history. I would need to look that up to see if there's anything interesting. But yeah, the company dropped quite a bit recently, because in October it was still $20 and now it's $13. That usually means there has been a significant event.
Yeah. And then the last question, hopefully we'll know more about this, is JEPI. JEPI is a popular ETF in the US of A. JP Morgan has launched an ETF, JEIP, which seems to be more European based, the UCITS. What's your opinion on these two ETFs?
So these generate high yield income, but these are not dividend growth ETFs. So as long as people really understand the risk related to these higher yieldings, then I'm totally fine with it. But I don't own it, because these are not dividend growers. If I want to have high yielding income like that, well, that's why I'm doing myself a bit of option selling. Yeah. So in my opinion, it doesn't fit in my portfolio. Although it may fit more in yours if you have this high income component, but not in mine. I'm really looking for dividend growth stocks.
Yeah. I think it has a place in some portfolios. We spoke about this income factory type portfolio where you create your own dividend growth based on high yielding. So I think it has. I believe this is probably in around cover calls and selling puts, more of an options based one. But look, I don't own it. I don't have it in my portfolio. But for higher yielding income based investors, I think it.
If you would
can be
own it
okay.
in your portfolio, would you seek a higher margin of safety when it comes to your expense crossover point?
I think so. With something like this, see what I find hard with this is the risk associated with this. I don't understand it enough to do that. Cover calls and all that seem great, and yes, it's generating high pieces of income. But what about in certain environments? Does it work in all environments? I don't understand the risk. So
I see
that's
what you
why
mean.
I try and not stay away from them, but I try and stay within my circle of competence stuff. And I do have high yielding components in my portfolio, but they are companies that I know, or funds like UK Wind or Solar that I'm bullish on.
I see what you mean.
I'm not bullish on.
Good.
Cool. That's the last question of the show. Thanks again to everyone for all the questions. And as I said, please pop into Facebook. Tell us about your own portfolio allocation. How does it differ from ours? We would love to hear from you. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.